All right, so today we're going to talk about that pesky old thing called depreciation. So just really quickly before we go into the calculations and the different methods of calculating depreciation, what is depreciation? Depreciation is when we buy a large asset, something that we're going to use for years and years, and we're going to pay cash out for it up front. But remember, when we purchase that asset, we're not going to treat it as an expense, right? Even though cash is going out, we're not treating it as an expense. We're going to treat it as an asset, right? We're going to buy something like a building, and we're going to have it on our balance sheet as an asset. Well, slowly over time, this $300,000 building that we purchased is going to slowly depreciate in value. The value is slowly going to come down, right? And so what we do is we take that $300,000 asset and we depreciate it over time. We slowly bring down the value of the asset until after, let's say if this is a 30-year asset, after 30 years, it's not going to be worth anything, right? So depreciation is our way to kind of spread out those costs over a period of time. So what happens is, and I'll explain to you what accumulated depreciation is in a minute, but over time we're going to have some accumulated depreciation, and then it's going to tell us our book value is going to decline. It's going to slowly decrease over time. All right. When you record depreciation, once again, this is one of those simple things, because the journal entry, regardless of which method you use, is always going to be the same. Recording depreciation is always going to be a debit to depreciation expense, and we know expenses have debit values. All right, debit balances. And then our credit is going to be to accumulated depreciation. Once again, this is a contra asset account, okay? Go ahead and put that in there. All right, so this is a contra asset account. This account is listed, as we see here, as a way of decreasing the value of our asset, which makes it a contra asset. It is not a liability, even though it has a credit balance. It's a contra asset, all right? Contra assets decrease the value of an asset. All right, so regardless of which method you use, this is going to be your journal entry. You're going to have a debit to depreciation expense and then a credit to accumulated depreciation. Depreciation expense is an expense account. At the end of the year, we consider that, remember, a temporary account, so it's going to go away. Accumulated depreciation is a contra asset. Keyword is an asset. It's a balance sheet account, which makes it a permanent account. So what's going to happen is we're going to slowly increase this amount of accumulated depreciation so we can slowly bring down the value of this building. Eventually, our book value is going to get to zero because it's not going to be worth anything anymore, right? All right, so with that being said, we can kind of erase the board. And the beautiful thing for you guys is, because you're viewing this via YouTube, you can always rewind, fast forward, or whatever the case is if I have to go too fast. All right, so there's three methods of depreciation. There's going to be the straight line, and I do a lot of abbreviation partially because I don't want to misspell things. But anyway, so I do a lot of abbreviation, so hopefully you can catch on as I abbreviate. So SL is going to be our straight line method. The formula to calculate the straight line depreciation is going to be the cost minus residual value, RV, times 1 over the useful life. All right? The beautiful thing about straight line is once you get it for the first year, it's the same thing for however many years we're going to continue, however many useful life years. That's the easy one. The next method is going to be UOP, units of production. The formula to calculate units of production is going to be cost minus residual value. So you'll notice there's a parallel there. It looks the same as a straight line starting out. However, when we get over here, it's going to change. We're going to multiply this by actual usage divided by total estimated usage. All right, units of production is usually if we purchase a machine and it tells us this machine is only worth 20,000 units. The total estimated usage is going to be those 20,000 units. What we're trying to figure out here for the actual usage is going to be, well, how many of those 20,000 units did we use this period, whether it's this month, this year, whatever the case is. All right. Here is where your formula is going to change from year to year. All right, everything else, the cost minus the residual value, the total estimated usage, all of that's going to remain the same from years 1, 2, 3, 4, 5, however long you go. However, the actual usage is going to change every time. So that's the one you want to kind of pay attention to. And then the third method of depreciation is going to be our double declining balance. All right, this one we're going to take our cost minus accumulated depreciation times 2 over the useful life. All right, so this one is a little bit different from the other two. Here is going to be our accumulated depreciation. Our accumulated depreciation is going to be what's going to change from period to period. So remember, accumulated depreciation is depreciation that has accumulated, okay? Like nice play on words there. All right, so accumulated depreciation for the first year is always going to be 0. We haven't accumulated anything. Accumulated depreciation for the second year is going to be whatever the depreciation expense was for the first year, okay? It accumulates. All right, and then the accumulated depreciation for the third year is going to be the depreciation from the first and the second year. All right, and then it's just going to keep accumulating as such. All right, and so pretty much that's it. You just plug in all the information that you have into the formulas and you've pretty much got it. Here is the one thing that you want to remember with the double declining balance is watch out for the last year, okay? Watch the last year. And it's really kind of hard for me to show this as an example unless I go through the full example. But what I will tell you is in the last year, you have to be careful because in our equation for double declining balance, we didn't take into account the residual value, what we think the asset will be worth at the end of its useful life. We didn't take that into account. In the last year, basically, this is kind of how it goes. Double declining balance will go on forever and ever and ever and ever and ever. You got to cut it off. In the last year, you're just going to plug it. So we want our balance at the end to be our residual value, which if there is not a residual value, then it's 0. Then we will depreciate whatever we need to get to that number. So let's say if our residual value is $2,500 and our running book value is it's 3,000, then that means we need to depreciate 500 to get from the 3,000 down to the 2,500. We don't do any calculation. We kind of don't even do this calculation for the last year. We're just trying to get to where we're trying to go. All right. I think that's it. If you have any questions, please make sure and leave them in the comment section of the YouTube video, and I will see you next time. Thanks.